Welcome back. Parikshit is now joining in. He's picking up some details with regards to Prime Minister Narendra Modi's likely visit to China amidst the US tariff war. Parikshit, tell us more.
Well, this will be a meeting of huge geopolitical significance. India and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. Prime Minister Narendra Modi is set to visit China for the SCO summit in Tianjin from the 31st of August to the 1st of September. This will be his first visit in 7 years. Sources say India's objective would be to instill positivity in the relationship. We've also been told by sources that the India-China relationship and the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn recently, India and China have been working on improving ties for the past few years, and more so after October 2024, when Prime Minister Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia. Both leaders have agreed to work together for a peaceful and stable India-China relationship, and they had also decided not to allow differences on the boundary issue to disturb peace and tranquility at the LAC. Since then, there have been multiple meetings at the level of foreign secretaries, NSAs, defense ministers, external affairs ministers. Sources say the consensus reached between Modi and Xi is now being given shape to ahead of the SCO summit in Tianjin. There are signs of a thaw as well. India has restarted issuing tourist visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flights. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease the supply of specialty fertilizers as well. China's restrictions on rare earth magnets have created a crisis for the Indian industry, and the automotive industry is very hopeful that a positive meeting between Modi and Xi will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with Indian companies wherever a technology partner is needed for Indian manufacturing. Also in a first since 2001, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. PM Modi is expected to have a one-on-one meeting on the sidelines of the SCO summit with Xi Jinping, and the meeting will definitely set a roadmap for ties for the next few years.
Okay, all right. Pariksha, thank you so much for joining us with those important details. This is an important story to track. We'll keep coming back to you for more. With that, it's a wrap on this edition of Trading Hours. Stay tuned. Halftime Report is up next. Welcome back. You're still tuned into Trading Hours. SmartWorks co-working spaces reported good Q1 numbers. Revenue surged 21%. Their P&L EBITDA expanded 55%. Their losses have also narrowed. Nitish Sarda, who is the managing director at SmartWorks co-working spaces, is joining in now to take a few questions. Nitish, thank you so much for joining in. Well, losses have narrowed for you this quarter. So could FY26 be the year where you will see profits on the bottom line? Also asking this because majority of your revenues are coming in from the IT space. We saw those layoffs coming in by TCS. Do you think that is something which could impact demand? What is the tenure of agreements with bigger clients of yours?
Absolutely. First of all, Sonal, thank you so much for having us on your show. SmartWorks has shown tremendous growth over the last year. We are well on track to become not just India's, but one of the largest flexible workspace in Asia with our presence in Singapore now. We are already India's largest with a total of footprint of over 12 million square foot and have consistently performed on improving all our financial metrics, whether it's our revenue, which has grown to 379 crores, which is a 21% jump year on year and almost a 6% sequential growth from the last quarter. Our cash EBIT or our normalized EBITDA, which is our NDS EBITDA minus all the lease liabilities that we pay, has significantly grown to almost 61 crores, which is a 100% jump from the same quarter last year. So SmartWorks is moving towards increasing all its financial metrics on a non-GAAP basis, which is removing the NDS adjustments that we have. We have shown a profit of over 16 crores in this quarter. because of the accounting provisions that we have to create, because in the high growth stage that we are in, there is a loss. But if you look at that loss, that has also meaningfully come down from 23 crores. We stand at 4 crores in this quarter. Last year, that number stood at 60 crores. In the first quarter of this year, it's only at 4 crores. So our metrics are increasing with the significant increase in scale. So it's a very good situation that we are in. To answer the second part of your question on the growth of the industry and the demand for our product, while obviously IT/ITES is a significant portion of India's commercial RE, for SmartWorks, that number is only 42%, which is lower than what the industry standard is. In commercial real estate, IT/ITES contribute to about 60%. So we have also onboarded a lot of manufacturing, BFSI, logistic companies into our platform who are expanding with SmartWorks across the country. And with our strategy of focusing on mid to large enterprise clients, the tenures that we are able to get with them are much longer in nature. On an average, we get a tenure of over 49 months with these large enterprises, and our occupancies are very, very steady. In fact, our committed occupancies today stand as high as 89%. So you'll see these numbers continuously go up.
Got that. Nitish, hi, Rima here. Adjusted EBITDA came in at 16%. In FY25, I think the number was 12.5%.
Yes.
So what led to the margin expansion on an adjusted basis? And can you hold on to 16%? And plus, you will repay the debt, right, that you raised right now from the IPO proceeds. So will that not overall help in you turning profitable even with Ind AS accounting?
Absolutely. Thank you for that question, Rima. I think for us, if you look at our total numbers, it is driven significantly by the increase in our occupancy and the new centers which are driving towards the profitability. Despite that high growth, we've been able to demonstrate an increase in EBITDA margins from 12.5%, as you mentioned, to almost 16% this quarter. It is driven basically because of 2 or 3 things. Our SG&A cost, which is our corporate cost, keeps going down. With the larger scale, that corporate cost gets distributed over a larger base. And I think with our frugality, our operational cost and other costs are also going down with the increase in occupancy. So all of this is contributing towards the EBITDA growth margin. If you look at our last quarter from the year, we had already grown. So 12.5% was the entire year. Quarter on quarter, that number is continuously increasing. And you'll see that trend from 9.5% in the first quarter last year. We ended the year at 12.5% on average, and we've started this year at 16%. So you'll see these numbers go up. From the use of funds, from the IPO money that we've raised, we've repaid 114 crores of high cost debt. That will help us reduce our finance costs significantly. The NDS profitability that you are talking about is also subjective to the new centers that we add. So if we end up adding a significant amount of centers in this year, the accounting provisions that you need to create is on the year that you add those centers. So it is very difficult to predict that. But on a non-GAAP basis, which is normalized for any NDS adjustments, you will definitely see a continuous growth. From a negative 3% last year, in the same quarter, it has grown to 168 million, which is 16.8 crores this quarter, which is a 4.4% PBT.
All right, Nitish, running out of time. I had more questions, but thank you for sparing time and joining us today. Wish you good luck for the rest of the year as well. SmartWorks co-working spaces there on the show. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour, and this is our special segment, The Big Story, where we highlight key stocks with themes and deep dive into their financial and historical performances. Today, we have Mangalam joining us. Mangalam, tell us first up, what worked for Honasa and Nykaa this quarter? Look at the moves on those stocks.
Yep, incredible moves that have come in on both Nykaa as well as Honasa, both new age beauty companies, beauty wellness, some beauty and personal care sort of companies coming in. Let's start with Honasa. You know, the revenue growth picked up post the last 2 quarters, which were a disappointment as the company was, rationalizing their offline dealer inventory. The overall revenues, they grew 7.5% despite a 200 basis points impact on their sunscreen category. Remember, this time there was a short summer on account of the unseasonal rains that happened, and that impacted their overall revenue by about 200 basis points. Add that back and there'll be a near double-digit growth. And we've also seen the margins improve. Yes, year on year, there was some drop in margins, but that was a lot less than what the street was working with. And quarter on quarter, there was a near 300 basis points improvement in the margin. So after 2 quarters of weakness, there are signs of recovery in Honasa, and that's what the street is betting on. On Nykaa, 2 things stand out in particular. One, beauty, which is the mainstay of the company, continues to do well. 24% revenue growth, 32% EBITDA growth. So out there, the margins have also expanded in the mainstay of the company. The second part, which is the fashion business, which wasn't growing as well, has now started to show some signs of growth. And there as well, the EBIT loss has declined. In fact, the EBITDA margin loss has declined by about 300 basis points. And their own brands, which have the highest margins in the overall business, House of Nykaa, their gross merchandise value has actually grown by 70%, which is a lot more than the company's own guided range of 30% CAGR over the next few years. So all these factors working for both Nykaa as well as Honasa.
So, Mangalam, this is one of the reasons, the fundamentals, right? In the case of Honasa, 2 subdued quarters, and now this quarter they've shown a strong performance. But, we're seeing a big move, 10% on Honasa. Nykaa right now is up 4-5%. How do the valuations stack up? How has the historical share price performance been?
So, historically, Nykaa, had been a bit of an underperformer post-IPO. Thereafter, we saw big surge, big drop. They've been fairly volatile. Now, there is some element of predictability coming in on Nykaa, and which is what the street likes, and which is why they're betting on it. The last 3 or 4 quarters that I remember on Nykaa, they've actually outpaced the industry growth. Before that, the underperformance came in on worries of competition, etc. For Honasa, it was a high flyer post-IPO. Thereafter, the last couple of quarters, there was that weakness. And that weakness led to a big drop of nearly halving of the stock price from the highs. The highs, I remember, were close to around 531 thereabouts. And which was, a lot big, a big gash that we saw from the top. And even after this 10% up move that we're seeing, the stock is still 45% away from its 52-week high. In the last 12 months, it's down 35%. And the issue price, the IPO price is 324. Even after this 10% up move that we're seeing, the stock is still below the IPO price. So in case of Honasa, they've turned the corner. Are the results incredible? No. But the stock price has fallen so much that any turn in corner has led to an up move. And for Nykaa, after the volatility, there's some amount of predictability which is setting in, which has taken the stock higher today.
Now that the results have played out and is showing up in the numbers as well, the very common question, what next for both Nykaa and for Honasa?
What next is, the answer that anyone seeks to, not just for these stocks, but in life in general. But let's talk about Honasa. The management has aspired focus categories. They're growing, which is 80% of their sales. They have grown in double digits this time around. And they believe that this category can continue to sustain high teens growth. So things are good.
What comes in their focus categories?
Focus categories would be, the Dermaco. You would have Dr. Sheth's. You would have a lot of these active ingredient-based businesses. You would have a lot of, the Mamaearth's own core brand itself. So all those factors doing extremely well for them. They believe this can grow in mid-teens. And the margins, yes, 7% margins this year, possible with the remainder of the year that is there, with 100 to 150 basis points improvement each year going forward. Now, here the thing is that they spend about 35% of their sales on advertising. They believe that for their mature categories, this can actually go down to about 27 to 28%. So this is about 600 basis points in terms of a delta that comes in out here. So that means that, over the next 4 years, 100, 150 basis points each year, that gives you that 600 basis points delta out there. For Nykaa, the biggest thing, everyone was wondering, okay, in a world of quick commerce, 15 minutes, 20 minutes deliveries, how will 2-day, 3-day delivery for Nykaa beauty products work? Well, they've launched Nykaa now in the metro. 7 cities they've launched where, products are delivered between 30 minutes to 3 hours. And that is something which the street believes that will lead growth going forward for the beauty business. Fashion business, it's severely under-indexed when it comes to the men's category. It's about 16% of their GMV, and that's growing at 74%. So there is headroom for that as well. And even as the losses narrowed in the fashion business, they believe that, it will break even in the end of this year with about mid-teen with about 10% sustainable margins coming post FY28. So all these are good. And this is just the first quarter that we're talking about. Second, third quarter, we have the festive season playing out. So big launches expected out there. And House of Nykaa, which is their own brands, Dot & Key, etc., that is likely to grow 30% CAGR over the next few years. So the way ahead looks good for them. That's also what the street is betting on.
Okay, and when you talk about street, what are the brokerages making of this?
On Honasa, CLSA has gone ahead and upgraded the stock from outperform to hold. They have a target price, from hold to outperform rather. They have a target price of 333 rupees. Jefferies, because of the EBITDA beat, have upped their EBITDA estimates by 3 to 11%. They have a target price of 400 rupees. I think they sum it up best for Honasa. They say it's a high risk, high reward play, and today is the reward which is coming in after a few quarters of high risk. And On Nykaa, ICICI Securities says that fashion business, which has grown 25%, has been led by 74% growth in the men's category, which is under indexed. So obviously, this will sustain from here on. Nykaa Now, which is the quick commerce foray, can actually be 10 to 15% of the beauty GMV over the next couple of quarters. So that's something we'll have to watch out for. And they have a target price of 230. They have an ad rating on Nykaa too.
Thank you. Very well explained, very comprehensive. We will be chatting with the management of Nykaa today at 12 p.m. on the Q1 earnings. So don't forget to tune in. But moving on, Jupiter Wagons is under pressure on the back of a weak Q1. Very weak set of numbers. I think the revenues are down 50%, profits are down 66%. Vivek Lohia, MD of the company, is now joining in. Vivek, you've already articulated that the reason for the performance, the weak performance, is shortage of wheel sets supplied by the Railway Wheel Factory of Indian Railways. Is this problem going to sustain in Q2? When do you see this problem recovering? And what happens to your guidance? I think you had hoped for a 5,000 crore revenue in FY26.
Yeah. So good morning, Rima. So we expect the guidance. I'm pretty positive on that. From July onwards, we have seen that the railway supply of wheels has stabilized considerably, and we expect things to improve in the coming months. So we don't, whatever discussions which we had with the railways, we don't expect any challenges going forward. Our wheel production itself is picking up this year. Our wheel plant, Jupiter Tatra Wagonka, we will be doubling our production capacity. In the last quarter itself, also, the supply positions were much worse than what you see from the railways. We pushed in about 4,000 wheel sets from our own supplies to take care of the shortfall. But if the wheel situation improves, and which we expect it to happen, we expect the whatever guidance which we have given, that will make it up in the coming quarters. On the private side, you see our performance is steady. We are building on the order books. And if you see the margins, per wagon margins, that has improved. And now with the, in the next quarters, once the revenues improve, you will see the EBITDA as well as the profit margins to improve.
Okay, Vivek, when you're talking about you maintaining your guidance that you have for FY25, what happens with CapEx? You had a 2,500 crore expansion plan. When will you start seeing the synergies from this CapEx that came by? And what about the capacity addition that you'll see because of that?
That the capex which we are talking about is completely on track. The Orissa wheel project which we are talking about, it's already the construction has started. We are very, very bullish on that project. We expect that from end of next year, I think the revenues from that project will start kicking in. It's got a big element of exports to the European Union also built into that project. So that is something which, and independent of that, our wheel business in Aurangabad is growing. As I've told you, this year we expect the revenues to be close to about 600 crores from that facility itself, which will go up to 1,000 crores in the next financial year. So on the wheel side, the capex, we are very confident that's on track. On the EV business, again, that business is now, we have launched our first vehicle. We are going to be launching 2 other vehicles by end of this year. We are expanding our dealership network. In the next 2 months, we expect about 8 to 10 dealerships to open across India. Again, on the battery side itself, we are seeing the battery business growing by about 200% month on month. And we have this month, we'll be launching our first BESS system, a 10 feet as well as a 20 feet BESS system. So that market is again, the demand in that market is very strong. And so we expect that business also to pick up.
Right. Two quick questions, Vivek. You mentioned your revenue guidance stands. Does your margin guidance stand as well between 14 to 15%? And two, what's the order pipeline looking like for you, especially because for a network as big as the railways, as much as the upgrades that you have seen in terms of coaches, the L2 from Utkrishт to the LHB, are you seeing more orders towards that coming forward as well? What's the order pipeline looking like?
So in terms of the margin guidelines, again, as I have told that per wagon margins have improved. So we expect the margin guidelines, we don't expect any kind of challenges on the margin guidelines. The order books, definitely before end of the year, we expect railways to come out with substantial orders. As you're aware that, under Honorable PM's Gati Shakti scheme, railway is expanding its network considerably, and there's a huge push to bring in traffic to the railways. So we do see that the order pipeline should improve. On the private side, again, we are seeing a huge traction. And if you see our private order book numbers, they continue to remain strong, and our deliveries also there is consistent. So in terms of order book, definitely before end of the year, we expect things to improve.
All right. Thank you so much for joining in today and telling us what the plans are for the company going forward. Quarter 1 was weak, but they maintained their revenue growth and EBITDA guidance. That's the word coming in from Jupiter Wagons. Time for a short break. Management of SmartWorks co-working spaces will join in next to discuss their Quarter 1 numbers.
Welcome back. Still 100 points higher on the index and 100 points away from yesterday's high of 24,700. Mitesh Thakkar joins in for a quick chart check. Mitesh, you still have the legs to go and retest yesterday's high. What's your call on the index now and your stock recommendations for the morning?
Good morning. So on the index, there's a good chance that we might actually get back to the upper end range, which is just above yesterday's high. 24,750 is what I've allocated as the level to watch. I think we are still in the process of making a choppy consolidation at a bottom around 24,400, 350 zones. And around 24,750, you might see some supply. You might consolidate for a few days in this range, but eventually then, there's a stronger chance of a reversal happening. So in that sense, I think I'm positive. On the stock side, I have a buy on Jindal Steel. In fact, metal as a pack is doing extremely well. Jindal Steel is a buy, the stop at about 1,002 for targets of 1,050 to begin with. Eventually, we may look at higher levels in the year. And the other stock which has come up with that is Hindustan Zinc. Buy with the stop below 424.5. Look for targets of 442.
Thank you very much for that. Now let's get a handle on the latest trends from the futures and options space. Manglam joins in.
Well, it's been a good day so far for the frontline index. If you look at the Nifty as well as the mid-cap index, both of them trading higher levels. The Nifty Bank is actually a bit of an underperformer in the sense that it's not gaining as much as the other indices are. But then there's no problem for the Nifty there because we have the metals index, the autos, as well as the pharmaceutical index, all these sectoral indices leading the Nifty higher, though there is absence from the Nifty Bank as well as the Nifty IT index. So two heavyweight indices are actually not performing in today's rally. The broader markets would have your portfolios feel a lot better today than yesterday. The same time yesterday, the Nifty was close to 24,700 mark. We still had more stocks there was an even keel of advanced decline. Right now, if you look at it, there has been almost 1,800 stocks which are in the green for about 1,000 stocks which are in the red. Those lines are fairly, distant through the course of today's trading session so far. Where do we go from here? That's the big question, right? On the one hand, there is support at the 100-day moving average of the Nifty, which is 24,531. We're slightly above that. But for us to see further short covering, the Nifty has to cross yesterday's high of 24,703 as well. And there are a lot of shorts in the systems. The FIIs actually are just 8% long and 92% short. So if we do cross past yesterday's high, we will perhaps see some short covering ahead of weekly options expiry tomorrow. And then we have the Nifty Bank, which is the 100-day moving average around that 55,000 mark, which is seeing a lot of support. For the Nifty is the 24,600 put, which is extremely active in today's trading session. Put writers believe that around 24,550 thereabouts, there could be some support coming in. The 24,600 call writers haven't given up hope either. They're saying that yesterday's high could act as a bit of a resistance. So 24,670, 24,700, as we move towards that area, we could see some supply. So 24,550 to 24,670 is the broad range that the street is working with ahead of expiry. A couple of stocks on our radar. Alchem seeing a lot of long positions being added for second day running. And we have fresh shots added on Suzlon. The company reported their numbers. There's been a big 27-28% jump in open interest on the short side here.
Okay, all right. Take that point. Thank you so much, Mangam, for joining us with what's happening in the F&O space. Let's take a short break. Up next, we'll be joined by the management of Jupiter Wagons to discuss their Q1 earnings.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back on Crypto Corner. Today we are going to discuss about the real world asset tokenization. Well, it's an interesting market. It has been going quite strongly as well. So when you look at the overall market, it is 25 billion worth of market at this point in time. It has been growing quite strongly. If you look at the last 3 years' numbers, it has grown up by 380%. Well, what is tokenization? I'll start with that first of all. It is the process of creating a digital representation of a real-world asset on a blockchain network, and it has been going on for the last many years now. It's just that in the last 3 or 4 years, it really has taken quite a strong lead. Now, what it does, it allows people to own smaller, more affordable portions of high-value assets. I mean, this could be large properties, it could be commodities, piece of art, etc. It does allow fractionalization or tokenization. Now, the distributed ledger technology enables assets to be easily broken down in smaller pieces is what it does. What we can do is, as I said, it can lead to larger things that can be held in sense of buying, selling, holding and trading asset classes. And the blockchain records this process completely. It does ensure that there is credibility to this and it is easily available as well in sense of records. Now, this can be done in sense of real estate, art, commodities, paintings, bigger assets, collectibles, company shares, mutual funds, you name it, and the real-world asset tokenization is being done quite strongly by various companies and countries as well. Just to name a few, Dubai clearly seems to be taking lead in this, and then you have BlackRock and Libre leading into this trend at this point in time. Interestingly, when you look at on where this market can really go, there is a forecast from McKinsey suggesting that it could be a 2 trillion of a market by 2030. BCG talks about 16 trillion by 2030, and StanChart in a report says that this could be a 30 trillion market by the time it's 2034. Now, let me break it down in sense of an example to you. Imagine that there's a property worth 50 lakh rupees. The owner aims to raise 5 lakh rupees. The owner does not want to sell it, does not want to put it out as a collateral as well. So what the owner can now do is, under RWA, he can tokenize this and convert it into ownership of a property into 50 lakh tokens. Now, what this does is it allows the owner to raise money by giving a tokenization or a fractionalization of its property as low as 0.0002% perhaps of its property ownership to another person. And many people can basically come in for this. Just to give you an example in sense of the Indian markets as well, imagine there's a student in Ahmedabad who can invest in a tokenized portion of a tech startup in Bangalore, which he wants to be part of. And then it also could be a fish business in Kerala who wants to own a portion of a cold storage business in Maharashtra. It could be you or me who wants to own a small portion of a yacht or a plane. That can be done by the way of tokenization in the markets. Okay. Well, with that, let's go for a short break, but more news and updates follow on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Patakia and Reema Tendulkar. A green-looking screen after markets ending at the day's low yesterday. It's a 100-point uptick on the Nifty currently, and it's led by metal index, auto consumption. Actually, you name it, most of the indices are in the green today, but metals definitely supporting what we are seeing on the index level as well. Nifty, FMCG and IT, they are in the red currently, but the kind of gains that we are seeing across the board, be the mid-caps, which is up 0.6%, be it the Bank Nifty, which is up 0.1%. It's an overall uptick that we are seeing across the board. Above 24,500 mark, actually very close to 24,600. We'll have to see whether things remain this way or we will see some changes when it comes to overall market moves towards especially the last hour of trade.
Indeed. And what also helps is the good earnings reaction, right? Like in Apollo Hospitals, Hindalco yesterday, but you can see the stock reaction today. Honasa, Nykaa, Premier Explosives, so many. But we've got an action-packed 1 hour coming up for you. So let's tell you. First up, we get chatting with the management of Senco Gold on the Q1 earnings. In our special segment, Crypto Corner, Manisha today puts the spotlight on real-world asset tokenization on blockchain. And the big story of the day, we'll put the spotlight on Nykaa, Honasa, both the big movers of the day. We'll decode the rationale behind the move, the key triggers, the valuation picture, a complete deep dive into the business models and the financials of these companies. A little later, 11:30, the management of Jupiter Wagons. And finally, on the show, we'll also be joined by the management of SmartWorks co-working space. So it's a power-packed trading hour. And straight away, let's go across to Hormis first to begin the show with the top buzzers.
Since you mentioned earnings reactions, those are the ones that are hogging the limelight today. First up being NMDC Steel. Of course, it was the first ever profit that the company has delivered, the demerged entity of NMDC. This is the biggest single day gain on record that the stock has seen, now 19% higher on the stock. We have had almost 4.5 crore shares traded compared to a 20-day average of just 5.5 lakh shares. The Archean Chemicals is the other one. That's not an earnings reaction, but it's the third straight day of gains. This is the biggest single day gain that the stock has seen since January of this year. Is now up 7%, was at one point up around 10.5, but we have already had 17 lakh shares traded compared to a 20-day average of 50,000 shares. Its unit has received the cabinet approval to set up a semiconductor facility in Bhubaneswar. Windlass Biotech is the other positive earnings reaction. This is the biggest single day gain for the stock since February of this year, 13.5% higher on that stock. And take a look at the volumes here as well. 3.5 lakh shares already traded compared to a 20-day average of just 30,000 shares. And from the stock listed at a discount, it made a low, and from those lows of June 2022, the stock is up 5x, and from its IPO price of 460, the stock is already up 2.5x. But to round it off, balancing it out, Aarti Pharma Labs on the downside today. This is the biggest single day drop since April of this year. It snapped a 3-day gaining streak yesterday, and the stock fall also comes on the back of strong volumes here. 6 lakh shares already traded compared to a 20-day average of around 75,000 shares. Back to you guys.
Thank you very much for that. Let's straight away go across to Senco Gold. Stock is surging on the back of a strong set of Q1 numbers. Top line growth at 30%. EBITDA margins have come in at 10%. We have with us Suvankar Sen, MD and CEO. Mr. Sen, morning. This is Reema here. You had guided for about an 18-19% revenue growth for this year. Now, Q1 has been strong, 30% revenue growth, and Q2 is the festive season, Q2 onwards. Can you up your guidance for the full year? What is FY26 going to look like? And what led to the margin expansion to 10%? And can you hold on to it?
So, thank you very much, Reema. The whole objective is that, we have the whole year ahead of us. And in terms of the guidance, we will continue to guide everyone with around 18 to 20%. But now that the Q1 has performed so well with above 30% of growth, I think that achieving 20% should not be an issue. We also need to look at how, we are looking at the numbers as Q2 is in progress and the festive season, in effect, has already started. Dhanteras, Diwali, these are all coming in October, which will be in the beginning of Q3. So I think that, Q2 will have a mixed kind of a reaction with the Shraddh period in the middle. But then the pickup will happen again back to Q3. So I think a 20% is a reasonable target and a reasonable expectation for every one of us. As we cross Q2 and move closer to Q3 end, I think we will be in a better position to guide everyone if there is any kind of an increase. And the reason for the profitability that has gone up, there are basically 2 to 3 reasons. Majorly, what we have seen is that our diamond jewelry sales, that has increased largely, our charge ratio, which was about 9.9 in the last year, 9.9%, has moved up to close to 11% back again. At the onset of this high gold price, people are moving on to buying more of diamond jewelry, and we've seen a 54% growth in terms of sales of diamond jewelry compared to the previous year's quarter. So that is how we are looking at the consumers. They are saying that now gold prices have moved up so much. Let us look at 14 karat, 18 karat jewelry or diamonds studded with those 14 karat and 18 karat jewelry.
So
and now
that
we
was
have also
exactly.
seen.
Yes, that's exactly was going to be my next point, because gold prices are at a record high yet again, Mr. Sen. Is this something which is keeping you a little conservative on the revenue growth side? 18 to 19%, you're saying you'll do 20% when you've already done 30% in quarter one. And what does it do with diamond sales growth? 30% already in quarter one. Will you be able to do better than 20 to 25% growth that you had guided for earlier? Ultimately, what does it mean for your margins?
So see, with the higher increase of diamond jewelry sale, obviously the way it has impacted in Q1, the margins will be on an upper side and it will improve. But then, what we saw in the previous financial year was that the mood of the consumer toward diamonds were a little lesser, but the mood is changing. We saw it in Q4 of the last financial year. We are seeing it back again in Q1 and Q2 also. The mood of the consumer towards diamond continues to remain robust. Now 9 carat has also become a part of the hallmarking scheme. So that will only allow the jewelers to provide more lightweight jewelry, which will be affordable, studded with diamonds. And I think that, yes, the festive season is there. But on top of that, what we are more positive about is the wedding season. So in the summer months, we this time never had that many weddings. But post Diwali, Dhanteras, November, December, January, we will have the number of weddings increasing. So I'm sure that, the consumers are just waiting for the right price. Once they realize that, yes, this is the price and the prices will move up further, or there is any kind of small correction, I think consumers will come back to the stores in big numbers and start buying again. Bit more, and the respect towards the commodity is very much there from the consumer side.
Multiple positive triggers that you are highlighting, Mr. Sen, but does that be a fair assumption that 6.8 to 7.2% EBITDA margins for this year is an achievable task? Or maybe considering the optimism that you are highlighting, maybe you would want to go to 7.5?
See, I'd rather say 6.8 to 7.2. And I don't want to, make everyone very euphoric. But let's be positive. And I think 7% plus is always a good number, which looks achievable with the current situation that is going right now. And one more thing, I would like to add on to this particular thing is that the monsoons have been good. We are already seeing that the rural market demand is picking up. And I think that, volumes is the only thing that one needs to look at. Volumes have taken a hit. The ability to buy that much quantity of gold for an individual consumer has come down. So we saw in Q1 the volumes of gold getting hit by 2.5–3%. If you look at the YTD numbers, it's down by about 10–12%. So yes, we have to make lighter weight jewelry, make it affordable for the consumer. And I'm sure that they will come back and keep buying gold and silver and diamonds.
So this 10% EBITDA margin, I understand you're holding on to your margin guidance, but this 10% in Q1, other than a higher contribution of diamond sales, studded jewelry, is there any other reason what led to that?
If you remember in the last, interview that I gave on CNBC, our hedge ratio usually stays at about 75 to 80%. But we kept the hedge ratio lower at about 55 to 60% for this particular quarter. I think that lowering of hedge ratio has allowed us to take a little bit of a benefit of the increase in gold price, and that has led to a little bit of marginal impact and positive impact on the overall EBITDA numbers for the Q1 as well.
All right, Mr. Sen, thank you so much for joining in and telling us what we're expecting from FY26. So the start of festive season, that could aid earnings, where there could be Shraddh at the start of quarter 3. The management is holding on to their revenue growth and margin guidance. Let's slip into a short break. When we come back, we'll put focus on the crypto market with Manisha Gupta on the other side.